I think there's a lot of things turning people off, and I just think people find it's easier to rent, and it's like easier doesn't mean better. I also, Jason sent me saying like, well, they're comparing these major cities and which is better in the last few years. I'm like, of course you're going to say now it's, it's the toss up, like, renting and buying around the same. Of course. I'm like, but you're taking like Calgary into consideration and Vancouver. I'm like, let's look at Toronto. Like, we're in a little bit of a down right now. It's a great time to buy.
Welcome back, everybody. This is the DC Talks podcast with Mr. David Chinelli. I'm your gracious co-host, Owen Osinde, and we are back in the DC headquarters today for a very, very interesting episode. To frame this show today, we talk about all the different costs that happen when you buy or sell a house, and we speak about them sparingly. But for today, we thought, why don't we just consolidate everything when we talk about all the single costs you got to account for when you're buying a house, so nothing comes as a surprise during that final period where everything is getting sorted. And that's what we're going to discuss today. And this is something that you'll be able to review, come back to more than once just to learn even more. It's one of those episodes that use this as a textbook moving forward. And I'll be asking David certain questions about all the different costs, land transfer tax, capital gains, closing costs, all these different costs that come up which can mitigate a sale to go in your favor or not in your favor. So we're going to get started. Mr. Chinelli.
Why do you feel he seems like so far away from me? I'm gonna get a little close. Can I sneak a little closer to you?
Yes. DC.
Am I stinky? You're moving away from me? Am I right?
Just for framing.
For framing.
We're looking good.
I know, brother. I know. Yeah, Sean says we look good, so we look good.
Mr. Sean John. So, Mr. DC.
Yeah, buddy.
You've been in the industry for 10 years now, as we've discussed last week.
2 weeks ago.
2 weeks ago. And you've seen a lot of things happen along the way when it comes to costs and things that you thought were good to go, but there's one little sneaky cost that comes up which throws off a sale. So as I mentioned.
Well, I would say that not necessarily for me personally, but I've heard of other things because it did happen to me personally. So there were some hidden costs which my agents never told me when I was buying, and that's why I kind of hated agents. One of the reasons why I've discussed this with my clients, they know I didn't want to be a realtor, is because something when you're buying a property should be enjoyable. And without knowing some of the costs, it was just frustrating the whole way through. I didn't know any of this stuff. So one of the light bulbs went on in my head was that when I kind of like decided, I'm like, okay, well, I wasn't decided. I think it was kind of pushed on me from the Lord above to become a realtor to help people out. One of the things that helps me and helps my industry and helps my clients is sitting down with buyers and having a buyer consultation so they know all the costs, so nothing is hidden.
It's a surprise, not a surprise.
Oh my God. I'm like, I didn't know that was a thing. I was like, I never, out of all the properties I bought before, no one ever sat me down and said, here's what your costs are. Here's what you need to do. Not even mortgage brokers. No one told me to go talk to a mortgage broker or mortgage specialist before I was even looking at properties. And it's unbelievable that people don't do that. Like the first and foremost, if you do a buyer consultation with me, before we even get to the hidden costs about what's associated with stuff, the first question I ask is, have you met with a mortgage broker? Because unless you know what you can afford, you don't know what you don't know. Like, then how can you go shopping, right? And it doesn't work always that, okay, you think you can afford like a $600,000 property, but in reality you can only afford a $400,000 property. Sometimes it's the other way around. Sometimes you think you only can afford a 6, but you might be able to afford 7, 8, 9, who knows? Again, don't take the maximum amount, whatever a bank offers you. I say that over and over again. But it's always good to know what your thresholds are, because if you're only looking at 600,000 properties and weren't getting what you were looking for, and reality was you should be looking at 7 and 8, 100,000 properties, because you're like, oh my God, that's more I'm looking for. So either way, it's always good to talk with a mortgage broker first. So first and foremost, I say mortgage broker, mortgage specialist as well. If somebody works at a bank, I like mortgage brokers because they work with Schedule A banks, like so two of them usually TD and Scotiabank. The rates are usually better than if you walk into the branch, and there's different products. But a lot of mortgage brokers also have different types of lenders and different rates, and there's sometimes some of the lenders have a specific type of clientele. Like I have this one mortgage broker I used to work at Fit for Less, and he's like, Dave, I like the shittiest kind of client you can possibly have. I'm like, what are you talking about? He goes, bad credit, all this stuff too. And he liked the shitty deals. He goes, that's my bread and butter. like, interesting. He goes, you know what? He goes, I have a program for just truck drivers. There is a lender that he has, because truck drivers was hard. Like, they don't always understand when they're on the road, how much money they make. And a lot of lenders don't understand the industry, but there's this one lender that totally gets truck drivers and how they earn and what they're able to afford. And they have a specific product just for truck drivers. So he goes, if you ever have any shitty deals, things that can't ever get closed, come and see me. I can get it done. I'm like, oh, that's good to know. Like, again, so that's what they do, right? There's always a product out there for every type of buyer.
When we talk about real estate a lot, especially when you're looking at people who are looking to buy, the only thing we discuss, or it's commonly discussed, is just sold percentage down, like 20% down, 5% down. And it creates like this allure that's all you need to do. Is like, oh, come up with a down payment and you're good to go. So it comes as a rude awakening when these individuals, these couples, like even like my sister, and I was talking to her and Peter, I was like, you need to know about this. And I said this in the family gathering, especially during Easter. I'm like, David's going to bring up this topic. Because I think I've learned a lot from you and I know these things. And
so if I went over here, I have my listing presentation here. So I'm making sure I don't miss anything,
exactly.
But I do. And I went through this talk with her. Yeah.
Yeah. And I'm like, but the thing is, people don't know this because they just think about
So I listed my buyer presentation.
Yeah.
Sorry.
Save for a down payment. And that's all you need to have. But we need to educate people about these things. Like, what happens on land transfer tax? How is that in Ontario?
Dude, even before going into that, right? Like, first of all, they don't know the difference we did for mortgages. So I talk about that. So that's one thing. It's like, there's down payment. I'm like, but when it comes to the money, the first money is not even your down payment. It's your deposit.
To deposit. Yeah.
So I'm like, do you know the difference? The next question I asked after the mortgage broker question, I was like, do you know the difference between a deposit and a down payment? And they look at me like, and I would say 95% of the people look at me like a deer in headlights. They have no idea what the difference is. And why is this important? Well, it's huge, guys. So first off, like Owen was saying, like traditionally 20% is what you put down. To get a traditional mortgage, a non-high risk mortgage, you put 20% down. Now, you don't always have to put 20% down. Under $1.5 million, you can put less than 20%, most of the time around 10%. But again, your mortgage broker talking about that. It used to be $1 million, now it's 1.5. Okay. But that's not the big thing, right? Like, you have time to pay for that down payment. A deposit's much different, right? A deposit is 5% here in Toronto. It's roughly around 5% of the purchase price. So to make things simple, say average homes are selling for $1 million. If you're going to put an offer on a property, right, 5% of that is $50,000. So you need $50,000. But where is that $50,000? It can't be in an RSPs. It can't be in your TFSAs. And it can't even be in like Simply or one of those online banks. Right. And why is that, Owen? Do you know why I'm saying you can't have it in those?
Because you need to have the money liquid. And
correct.
It's like you're negotiating in good faith, because if you're going there, you need to have the money right in front of the...
Right. So in your agreement of purchase and sale, when you're negotiating, right, the second number is like your deposit. Your deposit is a good faith gesture, like you said, but it needs to be, once you come to an agreement for a purchase and sale, that deposit of 5% needs to be into the listing brokerage's trust account within 24 hours, business days, right? 24 hours. So the next business day. So if you had a TFSA, there's no way you're going to get that cash into your bank account and over. It has to be liquid funds. It either has to be a bank draft. It has to be a wire transfer. It can come from a line of credit. Absolutely. Because that's cash. Anything that's liquid, like Owen said, if it's illiquid or somewhat illiquid, it's going to take some time to get into your bank account. You could lose the deal, right? So that being said, so if you know you're going to put an offer on a property and you know you're 100% and you have an RSP, take it out of your RSP, like however long, talk to your bank. How long does it take? Get it into your account before you put the offer in. Because imagine you find your dream home and it's going to take you a week. And if the other side, we could put an amendment in there saying we could extend it. But if the other side says, no, if you don't have your deposit within 24 hours, those are the rules. This house is not yours. You lost your dream home because you didn't prepare. This happened to me. This is how I know this. It's happened personally. We bought our matrimonial home. I forgot, it was back in 2007. It's on Royal York. Natalie and I, before we were married. And we didn't know what we were signing. The guy didn't tell me this, right? And he's like, okay, I need that deposit. I think it was like $20,000 or $40,000. I don't remember at the time. It must have been like $20K. It's about 5%. We paid $470, so let's call it $20,000. And he's like, okay, I need that deposit. I'm like, okay, yeah, well, Natalie's getting our RSPs. He's like, no, I need it now. I'm like, what are you talking about? You never once mentioned this to me that I needed this money. He's like, oh no. So thank God I had a line of credit. I went to the bank, got a bank draft, and we dropped it off. And so what that does, and then at that point, it secures the property. But if I couldn't, we were screwed, right? We would have lost this property.
And quickly, DC. So when you have the deposit, and that's when the agreement has been made that you've put an offer in, the offer has been accepted, and now you put a deposit. So if I don't have that deposit and there's a second offer, what is the time period before they before they accept another offer? If someone has the deposit and puts it in, like, do they give you like, is it like a time period?
So it depends on who you talk to, really.
Yeah.
Because if you got an agreement without a deposit, some people think that it's not a binding agreement, whereas other people say no, it is a binding agreement even without a deposit. So my brokers will probably err on the side of like, no, we're still in an agreement, we just need a longer time. But again, they can sign a mutual release saying we never got the deposit. So there's a little bit of a, like, I would say it's a gray area, but in the eyes of the law, it's not really. But yeah, like they really shouldn't be entertaining anybody else, but they would have to sign a mutual release on both sides for that deposit's not in, because they failed to, mutual releases, both sides agreed to back away from the deal. So good question, but most of the time that doesn't, I've seen that not happen before. And it's, I've had an agent call me back and like, we never got the deposit. They're not bringing it in. We have to sign a mutual release, but you can't just accept another offer.
Especially like under,
it still is kind of binding, but you can't accept
under like high duress. Someone wants to get the property like out of their hand. They want to move on, and you're here dilly-dallying with the deposit. They're like, you know what? screw it. I'm going to go with this offer. The deposit's here. I'm sorry. We tried. You didn't come through. I'm just curious, like, is it like a day? Like how many business days on average?
Yeah. Well,
that's
so if it's going to take longer, then it's going to be they probably have to do an amendment and talk to the other agent has to agree to it. An amendment would be to extend I have an agreement right now. It's been almost 3 weeks. We don't have the deposit. Sold conditional, but it's not really technically sold conditional because we don't have a deposit, right? So, but we've agreed to extend it in writing. So it's fine. So you're able to do that. But in traditional way, like you could lose the property.
Yeah.
Right?
Mm-hmm.
So then what happens? So that deposit now stays in the listing agent's trust account. And what happens to that deposit? Well, if you have conditions, you have a 5-day condition period. If you decide to back away from the deal, because we talked about conditions before, if there's something you're not happy with, whether you don't get the mortgage you wanted or something wrong with the property, and you've made the decision, this is not the home for us, you get that deposit back without deduction, right? It might take a day or two, but you have to sign what we call before mutual release, and you get that money back. But if you decide to move forward with it, or if you went with a firm offer, that 5% now becomes part of your down payment. It just stays in there. So if, say you're doing traditional, you want to put 20% down. You've already put 5% as the deposit. Now, on closing, you have to come up with additional 15% to make the 20%. You don't have to come up with 20% plus the 5%.
Oh, got you. Because I think a lot of people get confused between the deposit and also the down payment. So they're thinking down payment.
Right. But you've already paid 5% of it.
And do you feel like this also hinders people from actually pursuing a property because they think that I need to have the full 20% down, but they can make a deposit and still...
Well, this is why I always say you're 100% accurate. Like, well, we don't have this and don't have that. I'm like, it's not what you think. That's why you talk to a mortgage broker, because you explain everything that you have. And you say, this is all I got. What can I afford by doing this? What I was told when I first started the industry, and hopefully it still holds true, in order to get a mortgage, you need to have 2 of the 3 main ingredients, right? You need to have a good deposit, a good job, or a good credit score. As long as you have 2 of the 3, they can work something out for you, right? So if you don't have a good deposit, but you have a great credit score and a great job, you get a mortgage.
They can massage everything to make it work.
Exactly.
Yeah.
Right? So 2 of the 3. If you have all 3, you got a better mortgage, but at least work with 2 of the 3. If you have none of the 3, well, there's still ways around. You probably have to go to a B lender. You just always get a mortgage. I always say this. So we put it in the conditions. It has to be satisfactory to the buyer. But if you're getting a mortgage, because I can get you a mortgage anywhere, it's going to be 100% interest. You can be bankrupt in 2 days. It's not satisfactory. You can talk to a loan shark, get a mortgage,
Like there's always a way to get the money.
You get your ankles broken after 2 days. But listen, I got you a mortgage. You know what I mean? So that's why we say it's satisfactory, right? But again, people don't know that. So that's a good thing. So I always say the deposit, and the deposit is your lawyer will ask you for the rest of that 15%, let's call it, or 5%, whatever you're going to do, a couple of days before closing. And again, that has to be in your bank account, and that'll be like a bank draft or like something like that.
Amazing.
What was the next one? Do you want to talk land transfer?
So land transfer tasks.
You have a list there. You tell me, what's the order we're going next?
So there's legal fees, title insurance, home inspection, appraisal, land transfer tax, CMHC insurance.
You're all over the place, eh? So you're not going in order.
Oh, well.
No. Listen, so
I'm bringing them all together.
Yeah.
This is for you to tell me like what the flow is.
Okay, the flow is, the next one I would say is, okay, so let me just go through our expenses. Deposit versus down payment. The next one would be land transfer tax. Okay, so land transfer tax is when you're changing name from an old buyer to a new buyer. So, and basically when you're buying a property, the title has to be changed on the name, right? And that will trigger a land transfer tax. Just a way for the government to get in your pocket. They just want everything, right? It's like, yeah, they always one hand in the pocket, right? Anyway, so in Toronto, we have a second land transfer tax. So if you're buying outside of Toronto, it doesn't matter where it is outside of Toronto, Mississauga, Oakville, Burlington, Brampton, I don't care, Timbuktu, whatever. As long as you're buying in Ontario outside of Toronto proper, Toronto includes Etobicoke, Scarborough, all of them, right? The cities. But if it's outside of Toronto, you're only paying one land transfer tax, and that goes to the province. Inside of Toronto, it's two doubles, right? And we do have an app because we calculate because they keep changing. Like Olivia Chow added over $3 million now, an extra tax, so it gets bumped up. So over $1 million. It works on a tier system, right? So your first $50,000 is a certain percentage. Then it goes up, right? So the next tier they just add is over 3 million, then 4. They've added more. So the higher, the more amount you pay for a property, the more tax you get charged. It's not just a simple amount. It's the way it works. Okay. So the thing about land transfer tax is, well, the first thing, the reason why they added it in Toronto, they thought back in the day when Toronto was there's been a lot of sales, they thought the double land transfer tax would slow people down for the purchases in Toronto. It just didn't happen. The difference is like we pay less taxes in Toronto because we have a larger population. So when you have a budget, it spreads over more people. So I always give my mom's example. She lives in Vaughan for the time being. She's been there for the last 30 years. Our properties at one point were the same amount, like on paper by MPAC. She was paying double the amount of taxes. Less people in Vaughan. In Toronto, the budgets, that's how it works, right? So sure, you're paying double land transfer tax, but your property taxes on a yearly basis are less and less. So if you hold on to your property for 20 years, it kind of balances out. Let's call it that, right? Anyway, land transfer tax are due on closing. You cannot mortgage them. So you can't add it. So when we bought our house, I think our land transfer tax was $145,000. We had to come out of pocket. So on top of my deposit, I had to have an additional $140,000 to give to the governments. Thank you very much. So some people think like there's certain fees you can add on top of a mortgage, but land transfer is not. So you have to calculate what your land transfer tax is and set that aside. Because if you only have $100,000 to put as your deposit and you didn't budget for a land transfer, you have to take some of that out. Now, the good news is if you're a first-time home buyer, you do get 2 rebates. There's a $4,000 rebate for Ontario, and I think it's $4,370 or just under $4,400 in Toronto, right? So if you add those two together, you get just over $8,000, like $8,400 or something like that. I can't remember the exact amount. Like I used to know those numbers offhand, but
the numbers here, like, so it's like 0.5% on the first 55,000 and then 1% on 50.
That's the calculation.
That calculation, right? 55.
Dude, we don't do those anymore. We just put it into a calculator. We had to, this is the funny thing. For our exams, we had to know all these tiers of it too. In reality, in practice, how much you paying for the property? I put on my website, on my Treb website, and I'm saying, this is what you owe. Yeah, it takes like 2 seconds. Because they keep changing the threshold.
Oh.
It's not static. It's not years. So every year it keeps changing. So the numbers were changing. So it's like, if all the calculations I did 10 years ago do not pertain to the calculations today. They're totally different.
But the numbers I'm sharing like are relevant like right now.
Sure.
Updated. Yeah.
Until they change them next week.
Oh, that's how.
They could change them.
So it's like pulse. It's like, okay, we feel like this today.
Well, it takes a little longer. I'm being a little facetious here, but you understand, like they do change. So all they do is when you're a client with me, like I'll go in and I just Google and I go and I'll tell you to do it. And you go to Treb, Toronto Region Real Estate Board, and you put in land transfer calculator. Look, it's nice here. So over here, so this is the one right here. So if you can see it, it's clicking on here. And Well, the cool thing with this is like, if you want to know, you don't need a realtor to do this. It's TREB, TRREB, and you say la calculator, so land transfer tax calculator, and you put your purchase price in here. So if you're, say we're purchasing, well, what do you want to do?
Let's say 800,000.
So at $800,000, okay, you can calculate, and then there's the numbers. So at $800,000, if you're buying it here in Ontario, just in Ontario, it would be $12,475. If you're buying in Toronto, you double that, so it works out to just under $25,000. There's also a button right here. If you click first-time home buy and you recalculate, then they'll show the rebate. So now you're down to, if you're buying in Toronto, $16,475. There's no point of us doing it that way. Just see how quick that was? And anybody can do that.
Yeah. Okay.
Even you can do that.
So let's say $800,000.
Yeah.
We can do the deposit on the 800K or the full 20% on the 800K.
So $160,000.
$160,000 plus the 16K.
Yeah. So first-time home buyer, $16,475. Yeah.
Exactly. What comes next now that we've established land transfer tax?
So we got those two. Then you come into some incidentals. So for example, a lawyer fee, right? So lawyer fees are around $2,000.
On average.
On
and
average.
This is Canada-wide or like...
No, I would say here in Ontario. Like, so we've seen like less than $2,000. Like, again, you got to be careful when it comes to lawyers. If they're charging too cheap or too expensive, you shouldn't go with them. Too cheap of like, I told you this one story. We had a guy who got $700 lawyer and they kept kept sending him the agreement of purchase and sale. And 3 or 4 times they lost the document. They were so cheap. They had so many people coming in that it was just one of those, like, again, you get what you pay for. They were terrible. They were just kind of pushing through and just they barely got the deal done on time. That's the other thing. If they're too cheap, they have too many people online. They're not really focusing on you. Right. And then if they're too expensive, they don't want your business. They hoping they're going to tell them to fly a kite. And then, because they didn't really, so I'm like, oh, I'll charge you $3,500 to do this. I'm like, $3,500? Like, well, that's what I'm charging. So that's what we say average is around $2,000, right? Roughly, give or take a couple $100, right? So that's so that was also obviously due on closing. Now, a lawyer gets involved in 2 different situations. One is usually if it's a freehold, when the deal's all firm, you don't need to send it to your lawyer if you're dealing with a freehold property before the deal's firm, which means you've waived all your conditions. And the reason why is that they're going to start a folder on you. If you don't go through the property, you back away from it because it's a conditional period. Well, you're going to have to pay them because they already started a folder on you. Like, even if they just put a name on a tag, the clock starts ticking, right? So there's no point. The agreements and purchase and sales were all written by lawyers. It's a lot of prefab stuff. So unless you have something that's totally radical, like a condition in there, which is totally radical, you don't really need your lawyer involved. And if that's the case, your agent should be talking to their lawyer or somebody of their legal staff to figure out, how do I word this so the parties understand what I'm doing? So you really don't need a lawyer before the deal becomes firm. Unless you're purchasing some sort of that has a condo corporation attached to it, whether it's a POTL, a POTL I call it, or a condo corporation, then you're going to put a condition that you want to look at its status certificate, which that big document talks about all the finances and the lawsuits. It talks about the life of the property, if you should move forward with this deal or not. Then you look at that to make sure that the condition is waived. So that's where the lawyer fee is. You also put in there home inspection. So home inspectors, as you know, we had Tony here. It depends basically how much time they're going to spend on the property. Like Tony myself, I've seen Tony charges like smaller properties like $400, $450 up to when he did Derek's home. Like my buddy Derek, he's got a gorgeous, huge home. And I think it was like around $1,200 or $1,300 because he spent like 5 hours there. It was like, the house is like bigger than mine. It's like 6,000 square feet. So, yeah. And then you also sometimes pull inspectors. So I would say on average budget around $700 for most properties. For home inspections, we don't really do home inspections for condos. Okay. So in a home inspection, you're looking for big ticket items. It's going to cost you a lot of money to replace: roof, foundation, electrical, those kinds of things. Whereas a condo corporation, if you're buying a condo, all those big ticket items are owned by the condo corp. Yeah. So you can get a guy going to come in who's like, he's going to check your outlets, or like, it's all like stuff you can do. Like if you want to check if something's leaking and stuff too, like, well, you can do that with your eyes. You don't really need a home inspector to do that.
And this is already done when the condo is completed by the one home inspector who's checking all the units, or even if you buy the unit and the condo's done, let's say it's like a new build, I'm moving
part of your PDI.
But everybody gets their own home inspectors, even on a
No. It's so what you do is like when you're buying pre-construction, PDI is pre-develop delivery inspection, PDI. You have one or sometimes one, maybe two times to walk through the property, and you're walking with a representative of the builder, and you're identifying things that are done wrong in the property, right? So if like your washers, like things I've seen cabinets cracked, floors done, you grab a piece of tape and you put it on there, and it becomes part of your inspection, which they're doing that they have to fix. But you also have, when you're buying a brand new build, you also have tear-on warranty that also covers you. So the builder's going to fix anything in those first couple of years, plus you also have a warranty to protect you, right? If you're buying a property, that's a condo. Now, the caveat to that is, if you're buying a house that also even has tear-on warranty and you haven't done the pre-inspection to walk through, then 100% get a home inspector. I told you about the one time, Tony, I was in London, England, where my client had conditionally purchased a brand new home. And I was in London, and my client, I said, how's the home inspection going? We're ready to go to Hamilton. He's like, we need to back out of this deal. And he was a joker. I thought he was joking. He's like, no, Dave, they had missed so many small things that it was thank God we had Tony there. And they were just kind of fluff it off. And to the point that he missed so many small things, like forgetting to hook up air vents, plastic smelling, and like the wrong plastic smell when they're putting on the fireplace. There was covers wrong on the septic, not the septic tank, or the pumps, sump pumps, sorry. And it was just enough to this is the stuff we can see, what's going behind the walls. Like in the attic, there was going to be mold in there in a second. It was horrific, right? So if you're buying a brand new home, still do your home inspection, 100%. So yes, set aside some money for that.
Let's talk about appraisal.
A lot of times, so what an appraisal is you go to the bank first to get a pre-approval, right? So a pre-approval is basically you give all of your mortgage specialist or mortgage broker all of your documents, and they kind of give you a number what you qualify for, right? Then you go with your realtor, you negotiate, you get a price of the home. So this was happening a lot in 2016 where there were people who had problems. Say you qualified for $1 million. Okay. So I tell you, you qualify for $1 million, go shopping with the realtor. Well, the realtor going, and say you found a property and they're like, there's a bidding war. Start out 700. All of a sudden I'm like, well, I can afford $1 million. It went, and you were awarded the house at $1 million. Okay. Well, the bank wants to make sure that the property is actually worth $1 million. Even though you've qualified for $1 million, doesn't mean that house is worth $1 million. So they'll send a third party with an arm's length away that's not owned by them to go and independently see what the value of the property is. That's an appraisal. And a lot of times the banks will cover that cost. Sometimes you have to pay $400 or $500, but a lot of times it's covered. This is during the process if you're getting a mortgage with the bank. And if they come back and it's less, for example, in this kind of situation, say that property is only worth $800,000, right? So this is why you want to have a financing condition, because that appraisal should happen within that 5-day conditional period. If you've done your paperwork and your mortgage broker knows what they're doing, you should probably get an approval in the first couple of days, and then they'll send an appraiser on a rush. So within the 5 business days, the bank will agree to what you paid, because just because you were stupid enough to pay $1 million for $800,000 doesn't mean the bank's going to be holding the bag in case you default on their mortgage and they have to put it back on the market. They're not going to the ones that are saying that we're not going to the ones holding the bag.
The bank is protecting themselves for giving you more money than you actually need for you to do other things without money, as opposed to just put it in the property. That's what the bank is sending them, an appraiser?
No. So what basically the appraiser just,
like they get them getting a third-party appraiser, right?
Third-party appraisal is because you want to have an independent person saying, because if it was done in-house,
got you.
Right, the RBC would, like, for example, if RBC said, I'm like, well, this guy, I'm like, go do an appraisal and just come back with $1 million. The appraisal come back what the purchase price was, right? You can't do that. You want to have an independent person saying, no, this is what the market tells it's worth. So yeah, he's qualified for this amount. What was happening in 2016 and 2017 when we saw the downturn was like, what happened was like this, 2017. The market was going hot, right? People were like going, and then Kathleen Wynne came with that announcement in April, and overnight the market dropped. So the way that it was done in the past, and sometimes they still do this, they do 2 appraisals, but what was done in the past is that, yeah, sure, you get your mortgage approval. So if you went in firm or even had conditions, you're great. But if you're closing in 2 months, they would send the appraisal out just before closing. Well, if that house at the height of the market was worth $1 million, and now it's down to 800,000, like that example, that's not your fault. You paid for what the going rate was at that time. But now that the market's dropped, they were going back to the people like, well, the house was worth $1 million. Now it's worth $800,000. In order for you to close on this property, on top of your deposit, down payment, your land transfer tax, you have to come up with that difference. Otherwise, you don't have a mortgage with us.
I think where I was getting confused is that the bank is sending an appraiser. So they have appraising partners that they work with who they can actually, there's some validity in what they're saying and how much that house is.
Remember, bank doesn't verify the property, the price of the property. They do that for somebody else. So they don't, all the bank wants to know is how much did you pay? And is that the going rate? So they just facilitate the purchase because they can't tell you what they think it's worth. That's not their job. Right? So that's why you're like, but you understand how that was a problem. So that's why now they're doing within the 5 business days, they're sending an appraiser out there because they want to know in real time, is the property worth what you paid at the time? Because it wasn't fair to those people that purchased. If you had 17 offers on a property and you sold it for $1 million, and then you're like, maybe beat out the person by $100, whatever it was. Well, that was the going rate at the time. That's what it was worth. It's not your fault in 2 months when you want to close, because no properties close the next day. You're talking 30, 60, 90 days. The market had dropped so quickly that the property went from $1 million to 800. We hadn't seen that drop in a very long time. Well, the bank was like, well, that's the property now. Like, it's your own fault. And people were defaulting because they had an agreement and the appraiser was done 2 months later. It's not their fault. So that's why you're trying to do now. Now, also in this market, we're also seeing, be careful what bank you're with. RBC is good for this. They don't. Sometimes banks, Schedule I banks, are doing the appraisal within the 5 days. And then before closing, they're doing a second appraisal and they're saying, whoa, we don't think it's worth that anymore. Buddy, you gave me a firm approval. You already had the approval.
Like the rug underneath your feet.
So be very careful what bank you're with.
In the order of operations that we've just established, right? We spoke about land transfer tax. Where does that go in the order of like how things go when it comes to these costs? When we talk about appraisal, does it come right after? Well,
the appraisal is done through the bank. So the bank is going to charge you. So on closing, there'll going to be fees and stuff too. Yeah. So a lot of times, you might have to just pay with the credit card the day of, or like depending on the bank, right? So a lot of times I say this because my last few purchases we're purchasing, they got waived. So because we're making a big purchase, sometimes if you're good with the bank, they'll waive your $500 appraisal fee. So hopefully you get that.
Next up, we got this is where I ask you about CMHC insurance.
So if you're purchasing less than 20% down, you're able to do that. If you said up until 1.5, you could put less than 20%. But the bank is only allowed to loan you, 80% less, and they can't lend you, 90% without this insurance. So what it is anything less than that 20% down, you have to qualify for CMHC, or it used to be called Genworth. I forget the new name of it now. So what they do is you have to pay insurance. So for our example, the $470,000 property we purchased, I think we only put 5% down, right? So the out of the 15% worked out to being about almost $20,000, right? Was the extra. So they said, well, that insurance is going to cost you $20,000. Well, instead of us paying the $20,000, obviously, because otherwise we've done as a deposit, what they did is they added the 20% on top of our purchase price. So the $470,000 property in reality became $490,000. We were paying a mortgage on the $490,000 minus the 5%, right? So which is fine because an extra $20,000 a month it didn't affect this price. I think it was an extra $5 or $10 a month payment. But on closing, you have to pay HST on the amount that that you're insured for. So for example, on $20,000, 13% of that is $2,600. So on closing, you're going to have to pay the $2,600 on the amount of HST that you've borrowed. Yeah. And the other thing is so before I get into the one thing, I know we actually have to wrap up soon. There is one last thing. There's also disbursements. So when you're purchasing a property, the lawyer will give you a list of things. And also in this list, because I don't think it was on there, is anything that the owner's prepaid for that that you're going to be owning during that property. So for example, what do I mean by that? So our taxes here in Toronto, we pay all of the taxes by the first week of September, the first, after Labor Day or first day. So September 1st, 2nd, something like that. All of our taxes for 2025 are paid. So which means I'm good until December, right? But if I sell my property in October, right, October 1st, the new buyer owns the property for October, November, December. So for those 3 months, they need to pay me back those taxes I've prepaid for, right? So that's how it works. So that'll be also part of your discharge, the amount that your lawyer will tell you. Okay, he's already paid all his taxes, so when you owe David the $10,000, he's prepaid. This also works if you're buying a condo. So your maintenance fees are on the 1st of the month, right? If you're buying it on the 15th, right, of the month, well, you're owning the property of the 15 days. He's already paid. I've already paid the 30 days. So pay me back the 15 that you own it, right? Pro rata. That's just how it works. So you also have to take that into consideration.
So what I'm wondering is, what percentage of transactions fail because of these numbers not meeting the criteria, like where it fulfills the transaction?
I don't think there's a lot. Like my clients, none. Yeah, I'm serious. We don't really talk about it, but I've heard of I've heard of people suing people for they found the money for the land transfer tax because their agent, and as a friend of mine too, he was getting sued because he didn't tell people then buying in Toronto had a double land transfer tax. I tell all my guys, and it's all I sit down, I give them I also have a buyer booklet, which we send there, which has all of the cheat sheets. Because when you do a buyer presentation with me, there's a lot of information. I'm just threw you a lot of information. It's good to have the cheat sheet because what I'm doing is I give you a lot of information, but during the process, I will remind you. So I'm triggering your long-term memory. So by giving you this information, it's there, and then triggering. So I'll say something like, remember about the deposit, 5%.
You always just send a little message. Hey, remember this, remember this.
I'll text it or something too. Yeah. So this is why it's very important. This is why my clients are knowledgeable.
Yeah. And it brings up the fact because of so many agents out here. And as we in our previous episode 2 weeks ago, we're talking about how people are doing this part-time. And my concern, what I'm feeling right now is that if you're not really taking it as serious as you are right now with the buyer presentation and everything, these little things can just slip through the cracks. And it causes a lot of people frustration when they're coming to the end. Or like, you didn't tell us about this. You didn't tell us about this. You didn't tell us about this. And people have risked their entire livelihood, all their savings to do something, and then only to be met holding the bag at the end of the day because of these. This is why I wanted to discuss this, because I feel like it's such a painful thing at the very end to be surprised by something.
100% people aren't talking about land transfer tax.
Exactly.
That messed me up, right? I was like, so when I was buying our last home, which it was a pretty penny for that price. I told you, I had budgeted for that. I was like, what's this land transfer going to be? I'm like, holy, I calculated, I turned to Natalie, I'm like, holy shit, we could have bought a condo with that. $140,000 is a good down payment on properties, which are just,
Yeah. Do you think this is turning people off from pursuing real estate? Because now,
I think there's a lot of things turning people off. And I just think people find it's easier to rent, and it's easier doesn't mean better. Jason sent me saying they're comparing these major cities and which is better in the last few years. I'm like, of course you're going to say now it's a toss up, renting and buying around the same. Of course. I'm like, but you're taking Calgary into consideration and Vancouver. I'm like, let's look at Toronto. We're in a little bit of a down to right now, but it's a great time to buy. I was just running numbers with the other day, and I was saying, did you realize if I'll just show you a quick example. I know we got to go.
We just turned into a club. Club Elise. Club Elise at the back. Club Elise Ben.
So I was explaining how why you should be looking at condos. And I was like, so if you're looking right now, and I think the Toronto stats tell a really crazy, is it this one I was saying? So when you're buying a condo in 2022, the average price in Toronto was $793,000. Then in 23 went down to $784,000. Okay, that's okay. I understand that. Last year's $767,000. Do you know what the average sale price? So going from 2022 till this past month, do you know what the average sale price in condo was? It was $793,000. I just told you it went down. So, and then last year was $767,000. Average sale price of condos last month.
$685,000.
Oh, that's really conservative. No, $709,000. It's almost $710,000. Crazy. That's a 10% drop, a 7.5% drop compared to last year. But think about that. That's almost $100,000 drop from 2022 if you own condos. So this is why I'm explaining to people now. It's if you're looking for investment purposes, or if you're looking for just to buy something, you're not going to look at a better opportunity than the next, and I was explaining to my client yesterday too, the way we were explaining to condos work in cycles. And it's a wave. It goes up and it goes down. This is how the guy from Urban Nation was explaining to us. When the market gets hot, that's where pre-construction comes in. They start there's all these projects and they get sold bang, 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 bang. But then when they start to get built, And all of a sudden the prices start to drop because there's a lot of supply. And that's what's currently happening right now. Lots of supply. The market hasn't been great. There's been like the conditions haven't been great for people to purchase. So there's a lot of supply in the market, plus of the resales, plus now you have additional pre-construction. So supply has increased, so the prices have dropped. But this is only going to last, he was saying, it started to rebound at the end of 2026. And then it's going to start to creep up again. And when you're buying real estate, what I've always said to you, it's a long-term investment, right? So if you're going to buy this thing for 5 years, we're at the bottom here. So if you're going to buy it for 5 years, guess what? If you hold on to it, and if you're going to live in it, even better. It's your primary residence. You're not going to have to pay, capital gains on the property.
My neighbors are moving, as work tour is wrapping up, my neighbors are moving to the States for like a 3-year visa because the wife started, she's going to be working for Salesforce. And they're like, yeah, we don't know, we should rent it or sell it. Like if we sell, we're losing like $100K because it's a two bath. And I was like, how much are you selling it for? Like $740K. I'm like, $740K for that? Like, I think the value of it was at the 800,000 level. And now, so I'm like, that's a good price if you were to sell it. Like that's a steal, especially in the St. Lawrence market area with how
You should buy it.
with Corktown Station coming through.
Buy it. I'll work it out for you. Let's go put the offer together.
Anyways, everyone, hope you enjoyed that. All the details of the episode will be in the description. Calculator, I'm going to add that in there if you're looking to like calculate land transfer task. Any other technical information you're looking to find out, you know who to go to here. Mr. Chinelli's information will be in the description as well. Hope you enjoyed that. Hope this was an educational podcast for you. And revisit this when you're coming to buy over and over, just because these things can slip up and you don't want to be left holding the bag at the end of the day. And that dream home, that property that you want, you might lose it because you didn't factor in certain numbers. And that's the reason why we did this episode today. Mr. DC, any closing words to the fans and the listeners?
Talk to a realtor again. And when you're hiring a realtor, talk to somebody who's active, not somebody who just has their license. We're not all created equal.
Mm-hmm. Exactly. We'll see you next week, everybody. Enjoy the weather. Hope you're having a great summer. We'll talk to you soon. Peace out.